Hello everyone, my name is Emily Barber. I'm a senior accounting major at DePaul University and a tax associate at BDO USA. Today I'm going to talk about the 2013 changes to the tax code. I know for many of you this may not be the most exciting thing to talk about. However, as Benjamin Franklin pointed out, nothing can be said to be certain except for death and taxes. The changes I'm discussing today are especially important because they are either directly or indirectly the result of the Affordable Care Act. These changes are most likely to be permanent as long as the Act continues to exist in its current form. In addition, studies show that about 65% of Americans misunderstand the Affordable Care Act. Since its changes are so widespread, it's important that Americans start to understand its effects. The Affordable Care Act does disproportionately affect higher income tax bracket payers, but the changes I'm going to discuss today relate directly to middle income bracket payers. The four changes I'm going to discuss today are the net investment income tax, unreimbursed medical expenses, alternative minimum tax, and changes to payroll taxes. The net investment income tax is a new and additional tax on investment income of 3.8% on income from things such as interest, dividends, royalties, annuities, and gains on sale from property. The next issue we're going to discuss is medical expenses. Traditionally, individuals can deduct medical expenses on their income taxes if they are unreimbursed by an employer or a healthcare plan and if they exceed 7.5% of their adjusted gross income. With the changes to the Affordable Care Act, this amount has increased to 10% of their adjusted gross income, which is an increase of 2.5%. The third issue we are going to discuss is the alternative minimum tax. I know for many of you this may not be a common concept. For me, I know I had not heard about it until I took my first tax course. So just to break it down a little bit, basically what it is a complex and alternative calculation to determine one's tax liability. Usually it's used with people who have higher income because it prevents them from being able to take advantage of tax loopholes to decrease their tax liabilities. However, over the years, this calculation has not been updated, and so it's become more and more relevant to middle-income tax bracket payers. However, with all the changes that were occurring to the code from the Affordable Care Act, Congress finally did adjust this calculation for inflation, and it is estimated that it will lower taxes for about 60 million individuals who may have been affected by it this year. The last issue we are going to discuss are payroll taxes. These are also known as FICA taxes, and perhaps it's the most common or familiar to all of us because we deal with it on a regular basis. These are the deductions that are taken out of our paychecks and paid on our behalf by our employers to the IRS. The first issue we're going to discuss with payroll tax is the expiration of the payroll tax holiday. What this was is that the Social Security deduction had been decreased over the past 2 years, and they allowed that decrease to expire, so now it has the amount that is deducted from your paychecks is increased back up to the traditional 6.2%. So this was a 2% increase from the amount that has been deducted over the past 2 years. The next issue we're going to talk about with payroll taxes are changes to the rates on many of the payroll taxes. The first issue is with Social Security tax. They increased the wage ceiling to $113,700 per year. So this means that any income up and until that amount is subject to Social Security deductions now. Social Security tax deductions. In the past, this amount was about $110,000 per year. So it's roughly about an increase of $14,000 in wages that's now subject to Social Security taxes. The second issue with the rate changes on payroll taxes is Medicare tax. They have created a new and additional tax for Medicare deductions that is now subject to any income over $200,000 per year. Both of these rate changes are a little bit on the higher end of the middle income tax bracket, but because they are still under that $250,000 a year benchmark, they are still considered middle income. So just to recap what we talked about today, the four changes we discussed were the new net investment income tax, increases to the unreimbursed medical expense limit, changes to the alternative minimum tax, and changes to the payroll taxes. Please check out any of these websites if you are interested in this information further. I hope that you were all able to find this presentation informative and helpful. Thank you for listening.